Hey guys, and welcome to episode 8 of the Trader's Apprentice blog, Introduction to Trading Psychology. Now this one's going to be fairly in-depth and probably quite a long episode, so grab yourself a coffee, or in my case a Bailey's, and let's get into it. Okay, so thinking like a professional trader, an introduction to trading psychology. We're going to cover the next 6 topics, which is fear and trading errors, understanding the market, a different perspective, accepting the risk, probability and random outcomes, the importance of beliefs, objectivity, and becoming a mechanical trader. So let's get started. Fear and trading errors. It is often quoted that 90% of traders fail. Why? And how do we ensure we join the 5% that succeed? What causes this high failure rate? Is it due to poor fundamental analysis, inaccurate technical analysis, or the market's behavior? Perhaps the true underlying reason most traders fail is due to their own mental state or mindset and how they mentally interact with the markets rather than any method of analysis. Mark Douglas, author of Trading in the Zone, suggests that trader psychology has a greater importance on success than any other type of analysis, fundamental, technical, and so on, and that all trading errors are a direct result of fear. That brings us to the next question. Why do we fear the markets? It is demonstrated that we fear the market because we perceive an outcome. This would seem like common sense. We wouldn't enter a trade if we didn't think the trade was going to be a winner, right? Well, prior to entering a trade, we've studied the charts, identified our patterns, understood the trend, and patiently waited for the market to hit our entry point. So it seems all but logical that we now perceive an outcome. This trade is going to be a winner, right? Wrong. I'm hoping this video will demonstrate why this thinking is wrong. And if the goal of this video is met, you'll come to realize how we can so nonchalantly state, if it hits our stop loss, not a big deal, move on to the next trade, without fear, without reservation, and without emotion. Lord Ray has, through his own education and experience, understood and believed similar concepts as presented in this video. The problem with perceiving an outcome is that it links the trade outcome to our experiences or memories of previous outcomes, many of which have not met our expectations, thus resulting in fear. Let's look at an example. Let's say you have undertaken all your fundamental or technical analysis, entered a trade, and correctly placed a stop loss. The trade tracks in the right direction for some time and then starts to slowly move against you. Therefore, you think about how to protect yourself, which you do subconsciously, and you move your stop loss to your entry point to avoid losses. Is this the right thing to do? No, not necessarily. It's important to follow your trading plan completely and flawlessly, as I hope to show you. Hopefully, I will give you a different way to perceive market information and provide some concepts to help you start behaving like a professional trader. You will hopefully come to realize why moving your stop loss was not necessarily the right thing to do. When fear drives your decision making, moving your stop loss in the example, typically what you fear most creates the very outcome you are trying to avoid. Worse still, for your state of mind, it reinforced your decision to move the stop loss. Now what typically happens next? The market hits your new stop loss but doesn't reach your original stop position. Why? Because we originally set our stop loss at a correct location below a support level, after which the market swings again and turns out to be a winning trade, which you've just been stopped out of. Note, this is not to say you shouldn't move stop losses. The example shows that inappropriate movement due to thinking or perceiving market information. You must always commit to your trading plan, which should include appropriate stop loss movement. Other trading errors include not using stop losses, i.e. not cutting your losses, not predefining your risk prior to entering the trade. Why would you do this when we perceive the trade as a winner before we entered, right? And not taking profits, letting a winning trade turn into a loser. There are many more common mistakes that traders make, and I'm certain that collectively we have experienced them all. However, These few are the most common and are the ones that can result in significant losses or total losses of trading accounts. So how do professional traders avoid these errors? Why are they among the 5% that succeed in trading? Quite simply, professional traders have the right mindset, a mental state that doesn't allow these errors to occur. They trade mechanically, objectively, and most importantly, without fear or emotion. In the following sections, I'll explain how to think about and see the markets differently, and therefore start to remove fear from your trading. This will hopefully bring you one step closer to being a successful trader. Understanding the market, a different perspective. What is the market exactly? To put it simply, the market is a culmination of buyers and sellers, as you can see in the order book here, both with their own belief about market direction. You can either buy or you can sell. Essentially, that is all you can really do. Think on this for a moment. On any single trade, there is a buyer and a seller. Both are trading with the same objective in mind, to make money. No trader has the intention of giving their money away. A buyer enters a trade because they believe the price is undervalued and will go up. A seller sells because they believe the price is overvalued and the market will go down. Thus, every trade will always have a winner and a loser. When we look at the market, or more specifically the charts, what do we see? We see candles, each showing the momentum of the market at a point in time. Green candles represent buyers controlling price action, while red candles represent sellers controlling price action. Essentially, the charts are presenting the market participants' behavior on a timeline. We are seeing the beliefs of the market participants, sorry, I can't speak properly, I've obviously had too much of the Baileys, participants playing out in real time. I'll say that again. We are seeing the beliefs of the market participants playing out in real time. However, we also see continued reoccurrence of identifiable chart patterns. These patterns, combined with certain oscillators and indicators, provide a probabilistic outcome of one event occurring over another, which Mark Douglas defines as an edge. We'll come back to that a little bit later. Now think on this for a moment. If a particular chart pattern you have identified has a historically higher probability of a particular outcome in the context of the above, what would it take for this chart pattern to behave exactly the same as the previous time you saw it? The answer is, it would take the exact same market participants having the same identical belief about market direction and acting on those beliefs in exactly the same way they did last time, in exactly the same time frame. Now, how likely is this? It's categorically impossible. Now, this is extremely important. To perceive or to think a particular pattern will have the exact same outcome as the last time you saw it would mean that you would need to know exactly what every trader at that point in time believes, as well as how they will act. Therefore, again, it is categorically impossible to know what the market will do next. Once you completely understand that it's impossible to know what the market will do next, and you understand that there is nothing you can do to move it unless you're a multimillionaire whale, only then can you eliminate the possibility of perceiving any information from the market in a way that could cause fear. When you accept that any outcome is completely unique and you are able to look at the markets in that way, then you are no longer fearful. You'll be able to take steps towards behaving like a professional trader. Accepting the risk. Accepting the risk is one of the most important aspects of becoming a successful trader. Most traders think that because they are partaking in the act of trading, which is inherently risky, that they have accepted the risk. This couldn't be further from the truth. According to Mark Douglas, accepting the risk means accepting the consequences of your trade without emotional discomfort or fear. In the same way that you should align your beliefs so you cannot perceive market information as fearful, you should learn to interact with the markets without fear of being wrong, losing money, missing out, or leaving money on the table. Understanding that every single trade has a unique outcome goes a long way to cementing this belief. An analogy that is used quite often is that of a slot machine or a poker machine here in Australia. When you play a slot machine, you are identifying patterns which give you an outcome, a win or a loss. However, the risk is established at the start of the game. By that, you pay the machine a set amount of money that you are willing to lose, your risk, in order to commence the game. Should you not want to risk that amount of money, you simply don't play the game. Trading, however, is dangerously contrasting because it costs nothing in terms of initial risk to enter a trade. The risk, or the stop loss position, needs to be predefined before entering a trade. However, if as per previous you've entered a trade perceiving an outcome, it is far too easy to avoid using a stop loss, and instead of accepting a small risk amount, you could have a significant account drawdown or total liquidation. Truly accepting the risk means understanding and believing that each individual trade has a unique outcome. Including risk management with conviction to your trading is an absolute must to be a consistently profitable trader. The risk of trading, represented by possible stop loss amounts, are actually the costs of business for a trader. And once this is accepted, the trader can then act in a truly free state of mind. This concept of risk is tied together in the next couple of sections on probability and risk reward. Okay, so probability and random outcomes. Probability could be one of the most misunderstood aspects of trading. Probability, along with its relationship to risk reward, is critical to your success as a trader. In fact, many professional traders state that probability is all you really have as a trader. So it would be in your best interest to be very good at understanding it, right? A typical trader applies a probability or edge to a single trade and therefore has an emotional response, which is disappointment when the trade fails. This line of thinking again means that you have perceived an outcome. However, where professional traders are different, they understand the fallacy of thinking of probabilities in the context of the outcome of each individual trade. The best way to demonstrate probability, as a professional trader understands it, is with a simple coin toss example. The most basic principle of probabilities can provide the most profound aha moment when considered in the context of trading. As we all know, a coin toss has a 50-50 probability of a heads or a tails outcome. So if we toss the coin once, the probability is quite simply a 50% chance of landing on heads and 50% chance of landing on tails. However, let's say we have tossed the coin 6 times and the last 6 results have all been heads. What's the probability that the next coin toss will be tails? Will it be greater than 50% as we've just had 6 heads in a row? No, it won't. Unless we cheat with a weighted coin or a coin with 2 heads, anything other than a 50-50 outcome is simply not possible. However, what we do know is that over 100 coin tosses, if over 100 coins are tossed, there will be a very close correlation within a margin of error of an even split of 50 heads and 50 tails. So, for the purposes of demonstration, let's appropriate the game to a monetary outcome. Let's assume a situation where you win $10 for landing on heads and you lose $10 for landing on tails. That should probably say -10 for tails there, sorry, my bad. I'm pretty sure you guys understand this. So would you play this game? Okay, the net outcome over 100 coin tosses would essentially be a net result of 0, with a probability of 50% for each result, ignoring any margin of error. The greater number of coin tosses in the game, the closer the result will be to 50. So 50 times 10 minus 50 times 10 is the net result of 0, obviously, right? Now, let's change the game rules a little bit by just changing one variable. Assume now that landing on heads wins $15, while tail loses $10. Again, sorry about the minus symbol. Would you play now? Based on the same outcome of probability of 50-50, you would win 50 times 15, which equals $750, and lose 50 times $10, which is $500, for a net profit of $250. In trading, this is your risk reward. You're risking 10 to win 15. This is a risk reward ratio of 1 to 1.5. In combination with understanding probabilities, this is what will make you successful over the longer term, i.e., a large sample set of trades. The profound aspect of this situation is that each individual coin toss is still completely unique. Each toss has no more than a 50 chance of head or tails on any one toss, and you could either end up with $15 or lose 10. In fact, over the course of 10 tosses, you may actually lose 8 in a row. However, the rule still applies. Over a large 100 toss sample set, you will average at or very near the 50-50 outcome. This concept is employed by casinos, which I can discuss at some other point. The outcome of an individual trade is you will either win by buying high and selling low, or selling high and buying back lower, or you will lose, which is buying high and selling low, or selling low and buying back higher. What sets the professional trader apart is that they know that their strategy or their pattern or edge, in combination with risk and money management, i.e. risk reward, will absolutely provide consistently profitable results over the longer term. So the above coin toss example uses a 50% probability. However, assume that a well-developed trading strategy gives a trader a conservative 55% probability of a trade reaching only a 1-to-1 risk ratio target. Over a large sample set, the professional trader will still be profitable. Therefore, the professional trader unequivocally believes that they will constantly be profitable over the large sample set, albeit each individual trade outcome is unique. The professional trader, knowing there is nothing to fear, even if taking a loss on any one single trade, will still act with certainty on the next trade. He knows that the outcome of the last trade, or the last number of trades, is completely unique, and he won't be discouraged from taking the next trade if he has had a couple of losses in a row. The numbers used in the examples can have infinitely different arrangements. There are stories of traders who win less than 10 to 15% of their trades, but due to the risk-reward ratio derived from their trading strategies, they are still profitable. The takeaway point from this, which is why I'll mention it again, is that professional traders completely believe that, over a large sample set, he will be profitable. He understands the outcome of each individual trade is unique. The outcomes cannot be controlled, and therefore it is not rational to be fearful or emotional. The professional trader knows any monetary losses attributed to stop-loss occurrences are purely seen as the cost to do business, or the cost to see if your edge works this time. So, the importance of beliefs is the next section. The concepts presented in this video may take a little time to understand and implement into your trading strategy. Please listen to the video multiple times if you feel the need. These concepts will not assist or contribute to your consistent success as a trader until you truly believe them. Truly believing can take some time and is dependent on your level of commitment to working on your mindset, rather than the need to be actively trading. Most traders tend to blame external factors and make excuses such as, the fundamental analysis was wrong, the technical analysis failed me, or it was the market's fault. It made a move against me. Many traders will have massive drawdowns or lose entire trading accounts before they take complete responsibility for their losses, stop trading, and then start to work on their trading mindset. Mark Douglas describes beliefs and memories as energy structures within your mind. This concept, when understood, can do more for you than almost any trading strategy in regard to being a consistently profitable trader. Now, one way to describe this is by using the example of Santa Claus. When we were young, say 5 or 6 years of age, it would be a fair assumption that many of us believed in Santa Claus. Therefore, if mum or dad said, Hey, Santa is at the front door. You would run at full speed across the house to the door, expecting to be greeted by Santa. Santa's existence was simply a core belief in your mind. Now, assuming that there are no 5 or 6-year-olds watching this, or some parents may have some explaining to do, fast forward now to your adult life, where we all now understand and believe that Santa is not real. So, what does this truly mean in our mind? The theory is that both beliefs can coexist. The belief that Santa exists was and still is a belief in your mind, but so is the current belief that Santa is not real. What happens at a purely subconscious level is that our mind has removed the energy from the younger belief of Santa existing and reallocated the energy or put more energy into creating an unbalance into the belief that Santa is made up. Now, this is all well and good, but what does it mean as a trader? Well, this is simple. You have to remove the energy from your current beliefs, such as fear, the way the markets moves, and misunderstandings of probabilities, and align your beliefs with the concepts within this video. Sounds simple, right? And I guess it can be. But in the heat of trading with your own hard-earned money, all the other fears and beliefs can subconsciously creep back into your mind. And this is where trading errors will occur. Taking the time to believe in the concepts here in this video, while training your mind to follow your trading strategy, your edge, completely, without reservation, and executing your strategy flawlessly is the only way you'll be consistently successful. This is the reason why professional traders recommend paper trading before using your hard-earned money. Section 6, Objectivity and Becoming a Mechanical Trader. To close out this video, I will finish by expanding on the last topic mentioned in the previous section, which essentially suggests trading objectively and mechanically. How does a trader progress to the point where they can trade objectively and mechanically? To reach this state of mind, you have to bring everything together. You must unequivocally believe that the market cannot present information which can be seen as fearful. You must believe that you are completely incapable of controlling the market. And you must understand that each individual outcome is unique, irrespective of your edge or previous experience with any recognized pattern. You must learn to completely accept the risk, the cost of doing business, and think purely in probabilities. You must be able to trade without emotion, and as soon as your pattern or edge presents itself, you simply execute your strategy without overthinking. Once you become the mechanical trader and focus on flawless execution rather than profits, you will become a consistently successful trader. I'll say that again, it's important. Once you become the mechanical trader and focus on flawless execution rather than profits, you will become consistently profitable. The concepts in this video touch the surface of trading psychology. I highly recommend seeking further information from the reference source, Mark Douglas's Trading in the Zone, for a complete understanding. In fact, Mark has a number of seminars and the book is as an ebook, I guess, on YouTube. And if you do any searches, there's plenty of information there on Mark. Unfortunately, Mark has now passed away, so there won't be any more information from him. So rest in peace, Mark, but I guess he's contributed extensively to many traders in terms of coaching and assisting with trading psychology. That pretty much wraps it up, guys. It's a lot shorter than I thought it was going to be, so hopefully I didn't talk too quickly for you. Please review and re-watch this if you need to, or ask me any questions in Discord as always. Lastly, again, if you ever want to show any appreciation for the video blogs or you feel you get a lot of information from them, you're more than welcome to contact me to tip or show your appreciation. Thanks again, guys, and talk to you in the next one.